Hello, today is the 11th of August 2011, but let's go back in time to April the 30th, 1976, and take a look at this monthly gold chart. And this was a time frame when we seen the market or the gold market go from its historic level of $35 per ounce. That was the price of silver shortly after it was confiscated in the 1930s. The United States is now off of their gold standard, and well, it's an inflationary decade, to say the least. The first thing that I want to point out within this bull market is what happened from point A to point B. Point A is a breakout candle. It was in an uptrend, let's take the lines off. I want to put a trend line. As we can see within this time frame, it broke a resistance line that was hugging this band. Therefore, when something like this happens and you break the trend line, this is what it looks like. This trend line's just going to start moving huge to the upside. Gold was parabolic for about 3 months. It settled down, it went parabolic again, but from point A to point B, the gold price gained about a little over 100%, going from the areas of around $50 to about $125. Now, during the same time frame, this is when the silver market didn't do quite as well. It gained about 60% from the same point A to the same point B. Not only that, but this is when silver bottomed. Silver was in a bear market during this time frame in here. Now, we've seen within this chart how the market managed to hit this band, come back to the average. Hit the band, come back to the average. Didn't hit the band here, and it didn't hold the average. Now, another way of doing this is going from top to top. This is the distance from point A to point B. And again, this is a difference, not as big or as large of an uptrend, but still a good one. And not as good here. This is a situation where you make a higher low, but barely. And then from there, you can connect point A, and there would be a trend line. And of course, you can even see in a situation here, you're now seeing a support level become resistance. Now, the range was small, so it's not as bearish in a smaller kind of range. But if you look at the fundamentals within this time frame, you might be saying, you know what, maybe gold should be worth more. Yes, it was at 35, and well, it's triple that now. But how much inflation has there been since the Federal Reserve took over roughly about 60 some odd years ago? Quite high, to say the least, and you got to only think that would be continuing. And a lot of people don't agree with buying on weakness. They're saying you don't want to buy this in a downtrend. And the way I look at this is that Fibonacci works as well as it does. And I got this line just pointing out to me stating it's $101.70. So roughly in or around the area between 100 and 105. That's the area where you would expect it to find some sort of bottom. Now, the significant part when trying to find bottoms or trying to use those as entry points, it's only good if it's going to keep the bearish trend. And it can still come down here and keep the bullish trend as well. But when you have information for the trend to be very bullish and you get a correction, that's oftentimes where finding these points can work out very well. So now let's fast forward through into 1980. And we were in this downtrend back in here. And the market did manage to go close to that 103 level. In fact, if we draw a line here, then we get pretty much right on it. Now the level was, let me go back to the chart again, $101.70. Now I only have closing levels on here, which would also change the Fibonacci a little bit, but it did manage to go to 103. Therefore, when we look in here, we can see if you bought in here, well, you kind of did fairly well. It was also at the time at the lower end of the band, so it just hypothetically, well, it wasn't hypothetical, this is actual, it just happened to mysteriously meet up within the same time frame. Now, since that period went on, what we've seen is how we came up to this level and we managed to continue the trend of higher highs and higher lows. Again, we broke a resistance line. Again, we extended the bands. The resistance line was, well, there's many different ones to say the least, but they pretty much all broke. And the break came with this large size candle in here, and it continued with two more. You look for the volatility breaks when either one of the two bands really gets extended. And you don't really need the bands, but when you see things going parabolic, moving well above the averages, the chances are they're pretty much at or close to many different bands that can be used to state that the market is very overextended. Now this worked out to be the top. Unless you knew on a level for whatever reason that it was going to be, technical analysis here doesn't say yet that this is going to be the top. Now what we did before was go from point A to point B. So if we do that again, we go from point A to point B. And then the next one was a higher level. Obviously you need to make a higher high for it to be the case, and well, that never did happen. Now as far as these Fibonacci lines are concerned, we see here we have a Fibonacci level at 308 and 165. These are automated Fibonacci numbers, and sometimes you gotta look at what the price action says and state, well, what bottom am I going to use? It says here the low is 60, and well, the lowest number on here is 66, so how could the low be 60? Well, it's the last 100 periods. And it was the third period of the 100 that happened to be 60. So it's really not the greatest of Fibonacci levels. Therefore, what would be the good ones to use? Well, the first obvious one was this actual bottom that we were encountering before, roughly at around 103. So we can do some Fibonacci calculations now with the mathematical formulas. We can take the high price is 850, divided by the low of, we'll say, 103. And we'll take this number and put it to the power of 61.8%. Multiply it again by the low. The number we'll be looking for is roughly at around 380. 380. Now if we take the number again, multiply it this time, or put it to the, we'll take the number and put it to the power this time of 38.2%, multiply the low again, then that gives us about 231. But this wouldn't be the only Fibonacci that we would use. We would go back to the previous chart. Notice that the low happens to be 35, and therefore we know the high is 850, we know the low is 35. We'll do 850 divided by 35, and we'll put this to the power of 61.8, multiply the $35 low again. That gives us a price objective to $250. So those would be the numbers that we are looking for: 380, 231, and 250. I'll have to remember these numbers because I'm going to be finishing the first part right now. But we'll continue further later on and move ahead to 1985, 1986, as well as 1990 as we watch the bear market play out. Take care.